The U.S. Producer Price Index, PPI, surged by 0.9% in July 2025, marking the largest monthly increase in over 3 years, according to the Labor Department. This rise, which exceeded economists' expectations, is largely attributed to the tariffs imposed by President Trump on imports, leading to higher costs for U.S. producers. On an annual basis, wholesale prices saw a 3.3% increase. Core producer prices, which exclude volatile food and energy costs, also rose by 0.9% month-over-month, the most significant jump since March 2022. The data suggests that while U.S. importers are currently absorbing these tariff-related costs, they might eventually pass them on to consumers, potentially exacerbating inflationary pressures. The implications of these figures are significant for the Federal Reserve, which has been under pressure from President Trump to cut interest rates. However, the unexpected rise in wholesale prices may validate the Fed's cautious approach to rate cuts, as it continues to assess the impact of tariffs on inflation. The central bank's decision-making process is further complicated by the recent firing of the Bureau of Labor Statistics director, raising concerns about political interference in economic data. With the Consumer Price Index also above the Fed's 2% target, the upcoming Personal Consumption Expenditures (PCE) index release will be closely watched for further insights into inflation trends. The current economic landscape underscores the uncertainty faced by businesses and policymakers amid ongoing trade negotiations and legal challenges to the tariffs.
Social Security, a fundamental component of U.S. economic policy since its establishment 90 years ago under President Franklin D. Roosevelt, is encountering significant financial challenges that threaten its sustainability. Currently supporting nearly 69 million Americans, the program is projected to face a funding shortfall by 2034, a year earlier than previously expected, potentially reducing benefits to 81% of their current levels. This accelerated timeline is attributed to legislative changes, including the Social Security Fairness Act, which increased benefits for former public workers, and recent tax laws that further strain the program's finances. The debate over Social Security's future has reignited discussions around privatization, a concept that has historically been unpopular with the public. Treasury Secretary Scott Bessent's mention of Trump accounts as a potential privatization vehicle has added to the controversy, despite clarifications. Proposed solutions to stabilize the program include reducing benefits for wealthier retirees, increasing taxes, raising the retirement age, or modifying benefit growth. However, the political and public appetite for these changes remains uncertain, with polls indicating skepticism about the program's future availability among older Americans. Efforts to reform Social Security are complicated by political and ideological divides, with some advocating for a reduction in the program's size and scope, while others call for its expansion to better serve low-income retirees. As the number of beneficiaries is expected to grow to 82 million by the program's centennial, the urgency for a sustainable solution intensifies. The future of Social Security remains a contentious issue, with potential reforms likely to have significant implications for American retirees and the broader economic landscape.
Adyen, the global payments company, reported robust growth in its financial metrics for the first half of the year, driven by its embedded finance platform's expansion, despite challenges from reduced transaction volumes due to new U.S. tariffs affecting Asia-based companies and the impact of a strong euro. Adyen achieved a 20% year-over-year increase in net revenue, a 5% rise in processed volume, and a 28% boost in EBITDA. Excluding a significant customer, processed volume growth would have been 23%. These results highlight the platform's ability to enhance authorization rates and minimize fraud, while also aiding clients in entering new markets, particularly in the Asia-Pacific region. Adyen's strategic investments in infrastructure and its banking licenses across Europe, the US, and the UK have enabled it to develop relevant financial products for its clientele. The company is poised to explore the integration of stablecoins to facilitate faster transactions if there is merchant demand. Additionally, Adyen is preparing for the advent of autonomous agents in e-commerce, ensuring its platform is equipped with robust authentication, tokenization, and fraud prevention systems to meet evolving market needs. This forward-thinking approach, underscores Adyen's commitment to providing comprehensive financial solutions amid macroeconomic challenges.
The Australian Securities Exchange, ASX, opened higher despite a mixed session on Wall Street, driven by a concerning inflation report indicating that U.S. wholesale prices rose 3.3% last month, surpassing economists' expectations of 2.5%. This unexpected inflation spike has cast doubt on the Federal Reserve's anticipated interest rate cut in September, with traders now seeing a 7.4% chance of rates remaining unchanged. The inflation data has stirred market sentiment, as higher rates can suppress economic growth by increasing borrowing costs, particularly affecting smaller companies reliant on credit for expansion. In Australia, the S&P/ASX 200 rose by 0.3%, with notable performances in the banking and mining sectors. Westpac and ANZ Bank saw gains, while Rio Tinto and Fortescue Metals Group also advanced. Energy stocks were buoyed by Ampol's 7.4% surge following its $1.1 billion acquisition of EG Group's Australian petrol stations, a strategic move to expand its Yugo brand. Meanwhile, Baby Bunding's shares skyrocketed by 31.9% after reporting a fourfold increase in profits, signaling robust consumer demand. Conversely, Cochlear and Mirvac faced declines due to cautious growth forecasts and revenue drops, respectively. Globally, mixed performances were observed in Asian and European markets, with Wall Street's tech stocks providing some stability amidst broader declines.
Ghana has announced a significant policy shift by mandating that all state contracts be denominated in its local currency, the cedi, as part of a broader effort to stabilize the currency and assert economic sovereignty. This directive, enforced by President John Mahama's administration, revives a previously dormant 2006 law and applies even to projects funded externally. Finance Minister Cassiel Otto-Forson outlined this policy in a mid-year budget review, highlighting the need to address the negative effects of dollarization on the Ghanaian economy. Between 2020 and 2024, the cedi depreciated by 135% against the US dollar, while foreign reserves fell by 40%, creating a pressing need for monetary reform. The move aims to curb inflation, enhance the competitiveness of local contractors, and allow the Bank of Ghana greater flexibility in managing interest rates without the pressure of foreign exchange demands. This policy mirrors Nigeria's 2021 initiative, which temporarily stabilized the naira and reduced capital outflows by $2 billion. While the policy has been welcomed by some economists as a necessary step towards reinforcing confidence in the cedi, its success largely depends on strict enforcement and political support across government entities. If effectively implemented, the policy could lead to lower borrowing costs and increased investment, although skepticism remains regarding enforcement, with past attempts at similar reforms having failed due to lax implementation.
Lyft has emerged from the shadows of its larger competitor, Uber, by delivering one of its strongest quarters yet, significantly shifting the market narrative. The ride-hailing company reported record bookings of $4.5 billion, a 12% year-over-year increase, alongside a revenue rise to $1.6 billion. More notably, Lyft achieved a net income of $40.3 million, a substantial leap from $5 million the previous year, and an adjusted EBITDA of $129.4 million, reflecting a 26% increase. This financial performance is underscored by a remarkable improvement in free cash flow, with nearly $1 billion generated over the past 12 months. The reduction in incentive costs per ride from $1.82 in Q2 2023 to $1.03 this quarter indicates enhanced operational efficiency and contributes directly to the company's profitability. Lyft's strategic focus on mobility services within North America and its recent expansion into Europe through the acquisition of FreeNow positions it for potential growth in new markets. This acquisition grants Lyft access to 180 cities across Europe, broadening its market reach significantly. The company is also exploring opportunities in autonomous vehicles through partnerships with firms like Baidu and Benteler Mobility, allowing it to tap into the future potential of robotaxis without heavy infrastructure investments. As Lyft transitions from a growth-at-all-costs model to a sustainable growth strategy, its ability ability to generate cash internally rather than relying on external funding becomes increasingly valuable in the current high-interest rate environment. For investors, Lyft represents a focused, efficient player in the ride-hailing industry, offering a compelling alternative to Uber with its disciplined approach and potential for solid returns.
The recent agreement between NVIDIA Corp. (NVDA) and Advanced Micro Devices Inc. (AMD) to sell semiconductor chips in China under a revenue-sharing plan with the U.S. government has sparked a mix of support and criticism. Under this deal, both companies can sell their advanced AI chips, the H20 and MI308, in the Chinese market, with a 15% levy on the proceeds going to the U.S. government. Kevin O'Leary, a well-known media personality and supporter of former President Donald Trump, defended the deal, arguing it strengthens American technological influence globally by ensuring foreign reliance on U.S. tech infrastructure. He compared the levy to a tariff, suggesting it would ultimately benefit American companies through increased cash flows. However, the arrangement has faced backlash from various commentators, including economist Peter Schiff, who criticized it as a federal shakedown for taxing revenue instead of profits. Legal and national security concerns have also been raised, with critics pointing to potential constitutional issues and the risks of allowing advanced technology sales to China amid escalating AI development competition. Stephen Ratner, a contributor to the New York Times, expressed concerns over the national security implications and the unpredictability of government intervention in economic matters. The deal highlights the ongoing debate over balancing economic interests with national security in the rapidly evolving tech landscape.
Enphase Energy (ENPH) has seen a notable rise in its short interest, with the percentage of its float sold short increasing by 7.53% since the last report. Currently, 30.69% of Enphase's tradable shares are sold short, amounting to 29.22 million shares. This elevated short interest suggests a bearish sentiment among investors, as short selling involves selling borrowed shares with the expectation that the stock price will decline. The average time to cover these short positions based on trading volume is approximately 2.85 days. Comparatively, Enphase Energy's short interest significantly exceeds that of its peer group, which averages 7.81% of float sold short. While an increase in short interest often signals bearish sentiment, it can also create potential for a short squeeze, where a rising stock price forces short sellers to buy back shares, potentially driving the price higher. Investors should consider this dynamic when evaluating Enphase's stock performance, as it indicates a divergence from its industry peers and highlights a potential area of volatility in its stock movement.
Palantir Technologies has experienced a significant stock price increase, surging 130% since U.S. Representative Marjorie Taylor Greene invested in the company in April. This rise follows a period of weakness caused by concerns over the Department of Defense's budget cuts, a key partner for Palantir. The company, known for its AI-powered software platforms like Foundry, Gotham, and Apollo, reported impressive growth in its second quarter earnings, with a 47% increase in its commercial sector and a 49% rise in its public sector business. These results have fueled optimism, with Wedbush Securities analyst Dan Ives raising his price target for Palantir to $200, citing the company's unique positioning in the AI revolution. Palantir's stock currently trades at $180, suggesting an 11% upside to Ives' target, driven by its hyper-growth demand and strong unit economics. The company's Rule of 40 score of 94% underscores its superior performance compared to other SaaS peers. Despite its high price-to-sales ratio of 132, which positions it as an outlier among enterprise software stocks, investors seem willing to look past traditional valuation metrics, betting on Palantir's potential for sustained growth in the AI sector. However, prospective investors should be cautious of the stock's historically high valuation and potential volatility, weighing their risk tolerance and long-term investment horizons.
Bitcoin and XRP have experienced notable declines as traders focus on upcoming U.S. inflation data, which could influence Federal Reserve monetary policy. Bitcoin's price dropped toward $121,000, while XRP's recent gains, spurred by a favorable legal settlement with the U.S. Securities and Exchange Commission, have also retreated. The core inflation rate remains at a sticky 3.1%, which poses a challenge for the Federal Reserve's anticipated interest rate cuts. This scenario has led to ETF outflows and profit-taking, highlighting the crypto market's sensitivity to macroeconomic shifts. The U.S. Bureau of Labor Statistics reported a 0.2% increase in consumer prices for July, with a year-over-year inflation rate of 2.7%. Core inflation, excluding volatile food and energy prices, rose by 0.3% for the month. This persistent inflation suggests continued pressure on the economy, potentially delaying rate cuts and affecting speculative assets like Bitcoin and XRP. The outflows from U.S. spot Bitcoin ETFs, totaling $812 million on August 1st, underscore investor caution. Meanwhile, the XRP market is adjusting post-settlement, with liquidity concerns and broader economic factors influencing its short-term trajectory. As inflation data continues to unfold, key indicators like the Producer Price Index will be closely watched. If inflation pressures persist, the Federal Reserve may be less inclined to cut rates, impacting the crypto market's speculative demand. The interplay between inflation, real yields, and the U.S. dollar's strength will be critical in determining the future direction of Bitcoin and XRP. The market's reaction to these macroeconomic developments will likely dictate whether the recent crypto rally can be sustained or if a more volatile phase is imminent.